The disruption caused to business by the pandemic has meant that for the first time in more than 30 years, it's not been possible to publish our annual Midsummer Retail Report. Lockdown caught everyone, not just the business world, unprepared, and we all scrambled for a response. But several months on, there's more of a pattern emerging in how landlords are responding and what that means to the market.
And certainly the consensus is that traditional leasing structures are no longer entirely fit for purpose, and a much more layered response, which takes into account additional factors, has to be applied. The pricing of space needs to reflect the value of a store to all channels, stay aligned with changes in consumer behaviour, and offer parity with online. Readjusting pricing on an annual basis rather than every 5 years will be an important first step, but getting to grips with non-till based value is equally important. We're developing a model which encompasses both, calculating a base rent priced on a range of visitor-centric metrics, including footfall, visitor behaviour and spend. A top-up based on the number of people that pass through a store is then applied, similar to a cost-per-click approach that we see online.
After months of chaos, the UK retail leasing sector is beginning to show signs as to how it can move forward once again.
It would of course be foolish to overstate the level of leasing activity in comparison to even a year ago, but the fact is there are a group of occupiers, both new and established, who are looking at restructuring their physical store networks. Of course, they're often looking to shed space, but a growing number are also exploring where they want to establish a presence and how their store networks should look over the next few years. A good example of these two contrasting facets of the market is our work with the Carphone warehouse and also with Sky. We're advising Carphone on the disposal of its large UK store portfolio, but we're also working with Sky, who has only very recently entered the market to establish a network of high-profile new stores.
Across the retail property investment markets, a combination of continued retailer failures and the disruption of 2 lockdowns has made trading extremely difficult.
The pandemic effectively closed segments of our market, with the exception of the grocery sector, which saw substantially enhanced trading levels, and elements of retail parks, which provide environments that are more in line with a socially distanced world. This had a direct correlation on investor strategies, where we observed a marked increase in demand for supermarkets, whilst there was still interest in retail parks, especially where DIY, and in particular B&Q, are a proportion of the income. That said, like the leasing market, the picture is one of extreme asset stress, combined with potential opportunity.
Even prior to lockdown, there was a relatively low level of retail property development taking place, and that has been further stifled.
Alongside our acquisition work for our active food store clients, the majority of activity that we are seeing tends to be focused on the repurposing of retail assets. We are working on a number of really exciting projects across the country that are assisting the much needed process of regenerating redundant shopping space and replacing it with a mix of viable alternative uses. From the asset management of shopping centres to leading the complete redevelopment of properties into new mixed-use schemes, we are creating solutions for clients and adding considerable value to their assets in the process.
As we approach the year end and what would normally be the high point of the retailing calendar, the dampening effect of a second lockdown has been tempered by the tantalising prospect of being able to counter the ravages of the pandemic.
In many respects, the story about this year is how retailing has managed to continue in the most difficult situations. Even with the long and growing list of retail failures, there has been a core of activity. However, even if, as everyone hopes, the pandemic can be brought under control, there's no question that our retail sector has been irrevocably changed by it. For the past couple of years, we've talked a lot about repurposing retail, but from here on, we need to continue that process on an asset-by-asset basis, but also look at a comprehensive restructuring of how we create property that best serves the retail industry.